Hey everyone, Eric here. Today, we're going to build the ultimate marketplace financial model. By the end of this video, you'll understand both two-sided marketplaces and how to build e-commerce financial models for startups. Okay, let's get started. So, in order to begin, we're going to need to think first about customer acquisition. But remember that if we're in a two-sided marketplace, we need to both bring sellers onto the platform and buyers onto the platform. And for the purpose of this marketplace, because a lot of marketplaces operate differently, we're going to assume that we're a marketplace that sells services, something like Upwork or Airbnb, where basically you have clients who are looking for a service and you create the marketplace where you connect the buyers and the sellers, and you take a commission based on that interaction, that transaction. But we're not a marketplace that holds inventory like Amazon and does its own logistics. We're simply a marketplace that facilitates a service and we take a commission. So let's move forward then. So when you're launching a marketplace, the first thing that you're going to need to do, obviously, is build the marketplace. But once you have some sort of product in place, we need to do customer acquisition. So let's start this model with something really basic. So let's look at the advertising spend. And with the advertising spend, we're going to be able to allocate a certain amount of that advertising towards the acquisition of sellers and a certain amount towards the acquisition of buyers. And based on the spend, we're going to know how we can estimate how many new customers we're bringing in every month. And that's what we'll go through on this page. And there's a number of ways new customers will come into the business. So let's say we are spending $5,000 a month for the first 6 months. Then it's $10,000 a month. Again, I'm just making up some projections so we can project a business that's, scaling, ramping over time. And by the way, this model goes from January 2021 to December 2024. So 48 months, which is 4 years. And that's the typical sort of timeline when you're building startup financial models. You'll generally want to project either 3 years or 4 years out and try to figure out a way to ramp the business and see if you can find profitability during that period. Although a lot of companies don't. Okay, so $25,000 a month for year 2. And then let's say it's going really well and we ramp to $75,000 a month. And then we ramp to $150,000 a month. And so we're going to back into, at the end of the model, the full financial statements and figure out, okay, what's the profitability, etc. But for now, we need to figure out acquisition. Also, let's put our active cell as cell B2. Go to the View tab, click Freeze Panes, and click Freeze Panes. This is going to look at our active cell and lock everything above it and to the left of it. So if we go down, you'll see we keep that first row. And if we go to the right, you'll see we keep that first column. And this is something you should basically do on every single tab of a financial model. So then here we have a split. So I'm saying, okay, 50% of our advertising spend is going to go towards the acquisition of sellers, at least in the beginning. But then as we get enough sellers onto the onto the platform, it's going to go down. And then we're going to be focusing more on bringing buyers. And then correspondingly, I have 1 minus the percent of acquisition going to sellers. So you'll see buyers are 50%. And then the efforts to acquire buyers increases over time. But again, you don't want to try to acquire too many buyers in the beginning or else they won't have anything to buy if there's no sellers. So let's move into here. So first, let's talk about seller acquisition. What are all the ways that we are going to bring sellers onto the platform? So first off, let's talk about advertising. So let's insert from some different rows and let's look at the paid CAC. CAC is customer acquisition cost. And this is one of the most important metrics in any company. You're going to hear CAC or CPA, and it represents the amount of advertising you spend to bring one new user into the company. So if you spend $100 and you get 2 new users, you would say 100 divided by 2 is 50. So your customer acquisition cost is 50. So let's say to get sellers onto our platform, it's kind of expensive. So it costs $250 of advertising. But with this piece of information, we know that through paid channels, if you take your total ad spend and you divide it by your cost per acquisition, we can expect that we're going to bring on 10 new sellers onto the platform if we spend $2,500. So first off, let's round this. It's the round formula. You do round, then you put your math here, comma, number of digits. We want it to be 0 because we're talking about actual humans, so you can't have a decimal. So 10. But there's another element of this. You're always going to have people coming into your business and buying through organic channels. Organic means channels that you did not pay for. So that could be word of mouth. That could be through Google, like search engine optimization. That could be many different things, but you'll have people coming in for free that you didn't advertise to, but want to be your sellers or want to be your clients. And over time, businesses have a larger and larger percentage of their overall activity driven by organic channels, or at least they should. So you're going to have a ratio. And I mean, the easiest way to think about this is a ratio. So that's what we're going to do. So the organic paid ratio is saying for every 10 sellers I pay to bring on, I'm going to bring on 50% of that total in organic sellers. So here's what I mean. New sellers, organic, and we're going to use these same metrics for calculating the number of new buyers or the number of new clients. So we're going to say, okay, round, it's going to be 10 new sellers that we paid for, and then, comma, 0 decimals, that's going to be 5 new sellers that came in organically. So that's going to give us a total new sellers total, which is going to be 10 plus 5, so 15. And let's take the $ away from that. But let's say we also have a small direct sales team that's going to be tasked with onboarding new sellers through like direct sales. So let's say the direct sales team, this is just like the head count. And let's just say we start with 1 person. And the reason why I'm putting everything in blue is because in financial modeling and in business, you want to put everything in blue. That's like a hard-coded assumption, meaning you just typed it in. And things in black are formulas. So you can see this is just 250, but 10, it's because it's a formula. And so that allows you to organize and keep your models really neat. And it also makes it easy to make adjustments to your models once they're already built. So the direct sales team. And now let's say, okay, how many new sellers does one direct salesperson onboard in a given month? So let's say sellers added per month per EE, which is employee. So let's say a typical direct salesperson can onboard 5 new sellers in a month. So you have your new sellers driven by your sales team, and that's direct sales team 1 times 5. So in each month, you have 5 new sellers coming on from your sales team. So let's do a little projection. Let's just say that goes to 2 over time. And let's copy all this forward. So in the beginning, from your efforts, you'll be bringing in maybe 15 new sellers a month, and your sales team will bring in 5, and they'll be bringing in 10. So that's going to help you build out the platform itself. So if we pull this forward out to 48 months, Control V. Okay, great. Okay, so highlight the row, that's Shift Spacebar, and then insert rows, which you can do through keyboard shortcuts. If you're interested in learning more about Excel keyboard shortcuts, I have a course on Udemy that teaches basically A to Z, all the keyboard shortcuts, how to navigate through the menus, how to do anything in Excel without a mouse. Really improves your productivity a lot. If you're interested, there's a discounted link in the description below. Please take a look. So here we have our sellers, right? We have new sellers from advertising, new sellers from our sales team, but we're gonna have a certain amount of the sellers that basically each month like just become inactive or cancel their account or whatever, and that's something called a churn rate. Churn rate is the number of customers, whether that's a seller or a buyer, that basically cancel or abandon your business. And so let's say each month we lose 5% of our sellers to, you know, whatever it is, whether it's this or some sort of competitor or whatever it is. So now we'll be able to calculate the total active sellers. So we'll have new sellers, which is obviously total new sellers from advertising, total new sellers from the sales team. And that will be, you know, each month it'll be 20 and then it goes up over time. But then you'll have returning sellers. So in month 0, you won't have any of those. And you'll have churned sellers. And then you'll have total active sellers. So, okay, what am I doing here? So churn sellers, so for total active sellers, you're just gonna say, okay, how many sellers did I bring onto the platform each month? And how many sellers left the platform each month? And those two things added together is gonna be total. So your returning sellers is gonna be 20. Your new sellers is 20, but your churn sellers is negative. Let's do round also so we don't turn a person into a decimal. So 20 times the 5% that canceled, comma, 0. So that's going to be negative 1. So let's just change the format on that a little bit. And then we know that our total active sellers is now 39. Okay, so we can just take this and copy it forwards now. And we can just see sort of like over time, okay, how many sellers do you have? And, you know, through all these channels. And you'll see that by the end we get to 1,837. Okay, so now we've got the supply side addressed. And let's talk about the demand side. So where are your buyers going to come from? Well, you're going to have buyers that you're driving onto the platform yourself. You're pulling in through organic or you're pushing in through advertising. And then you're going to have seller-driven clients. So probably each seller, as they sell their service, is going to be reaching out into their network. So one of the advantages is sellers onboard clients for free. So you have a certain amount of your new clients will probably just come from sellers doing their own marketing. So first off, you have your advertising spend and the allocation to your buyers, 50% of it, but then over time it goes to 85%, remember. So that's what we have here, just that's calculating 50% times the advertising spend. And so let's think about this. So we're going to use a lot of the same metrics right here. So we're going to look at a paid CAC, but in this case, it's probably going to be significantly cheaper to onboard a new buyer. So maybe it'll be $50 bucks. And then from that, we can calculate new buyers paid. So we say your advertising spend divided by your CAC is going to be 50 new clients. Okay, great. But what about your paid to organic ratio? And so these ratios will change over time, but it gives us basically the construction of a model that should be relatively reflected in reality. And when we see the real numbers come through, we can put in the real assumptions, but this should be a good way to model this stuff. So let's say we start out at 50%, similar to the other one, right? So you're like, okay, for every 2 buyers we bring on through paid channels, we're going to bring 1 on through organic channels. And then we have our new sellers organic. and then obviously total sellers. But here I want to show something interesting. So first, round paid buyers times the paid organic ratio, and then round to 0 digits. So, so here you're going to have your 50 plus 25, right? But these are probably going to change over time. So maybe in the first year you're doing like really heavy paid acquisition, right? But paid acquisition is expensive. You pay $50 in marketing to bring on one new client. And in a minute, we'll talk about the order value of the client. But over time, this number will probably go up. So, so let's say in year 2, it goes from 50 to 75. So that means for every 4 paid clients you bring on, you'll bring on 3 organic clients. And then let's say it goes to 100. So for every 4 paid clients you bring on, you'll bring on 4 organic clients. And then finally, let's say in the final year, it jumps way up to 200. And you might be saying to yourself, well, that's kind of crazy. But if you think about a platform like Airbnb or any of these big marketplaces that are successful, probably the vast majority of their clients come through organically. They come through Google, they're Googling a certain service, they see it on the news, their friend tells them about it. So that is something called network effects. And network effects are when you have basically a platform, and the platform with each incremental user becomes cheaper and better quality, and the ecosystem improves itself as it scales. And that's one of the really interesting monopolistic characteristics of technology companies is a lot of times they become better and cheaper as they grow. Whereas other types of businesses will get more complicated as they grow because they get harder to run. But technology companies, on the other hand, get these advantages through their scale, through things like network effects. Okay, let's just save this. Wouldn't want to lose this. Oh, and it looks like I just labeled this wrong. Apologies. Total buyers. Total buyers. Just do that now before someone tells me in the comments. Or we can say total new clients. Maybe that's a little bit easier to think about. Okay, so now we have seller-driven clients. So like we talked about, we have new clients per seller per month. And so these are, okay, if you're a seller and you're doing your own marketing, you're selling your service, you're probably telling people in your network, hey, come buy my service on this platform. So let's say that each seller brings on 2 new clients a month. And then we have new clients from sellers, and that's going to be 2 per month times total active sellers. So that's actually impactful when you're only bringing on 75 new clients a month, that your sellers can onboard 40 additional clients for you. So let's just multiply that forward. And then we're going to have total new clients acquired. Before we add this up, if you like this content, please like this video, subscribe to my channel, and share it with a friend. It would really help me out, and I'll keep making content like this. Okay, so total new clients acquired is 75 plus 40. So now we have the new monthly clients acquired each month. That's great, but each client that we acquire, say all the new clients in January 2021, are going to be coming back and buying over their customer lifetime. So probably some percentage of those clients are going to be buying again in February, March, months, and even years later. But how do you calculate that customer retention behavior? Really, with any business, and we always look at this with e-com businesses, there's only one accurate way to calculate customer retention and really to calculate the revenue. And that's through a customer cohort model, which we are going to look at right here. So what I was just talking about is that customers will buy in a certain month, and then they will basically come back and buy over a period of time. And it's really easy to think about that when they're like on a subscription and you're like, okay, the typical customer stays on for 6.5 months of the subscription. But what about when your customer has less predictable buying behavior? Well, you really need to look at customer cohorts. So initial month. The initial month would basically be January 2021. So this you would look at month 0. Month 0 is the purchase month. And then these are subsequent months when they would come back and buy. So for our retention here, month 0 is 100% because this is when everyone buys for the first time, the January 2021 cohort. Month 1 is, we put in some assumptions, 20%, 12%, 10%, 8%, 5%, 5%. And our model is 48 months. And we said that basically customers who buy in January 2021, some small percentage of them, 5%, is going to continue to buy each month for even 4 years later. There's going to be 5% of them that come back each month and buy something. Now this is very typical. These are your whale customers who will ultimately generate your business the vast majority of its profits and have a really high customer lifetime value, which is like the cumulative profit that you generate from one person over the lifetime of your relationship with them as a company. So here's how you do this. First off, you could link in all your individual months, February 2021, by doing equals and going in, but there's actually a formula which is called transpose, which will rotate your data 90 degrees. So let me show you how it works. Go to this cell and you need to highlight the area where you're going to pull in your data. So shift down arrow. So I'm highlighting 48 cells. You can see 48. There we go. You can see the 48 right here. And so you need to highlight the area that you're going to transpose into. Hit equal, transpose, and it's kind of a funky formula, but it actually works if you do it right. Go back to your acquisition model, and you're gonna select this whole area. So I'm just holding shift with the right arrow right now. And then check this out. Close parentheses. And now this is the funky part. You hold shift, control, and then you tap enter. And you'll see it pulls this whole thing in for you and it rotates it 90 degrees. So now you can see we're about to pull in the clients who bought for the first time in February 2021, who bought in August 2021, who bought in December 2021. So let's really quickly transpose the new buyers in as well, exactly how we did the months. So transpose, and again, you could link these cells in individually. It's just that this is easier. So the acquisition model. So here we have our total new clients acquired. So if we look at January 2021, 115 clients bought for the first time in January 2021. It was 153 for February, etc. So we're gonna highlight this data, Control Shift, right arrow, close parentheses, Control Shift, enter. Again, you don't have to do transpose, just looks pretty cool and works well. So what just happened? So let's look. So you basically have all of your clients who bought, and I'm just gonna freeze panes again. So view, freeze panes, so we don't lose this initial month. So this is your cohort, January 21 cohort. 115 clients bought for the first time, right? But what about 1 month later, which is February 2021? We're expecting that 115 January clients came back and 20% of them purchased a second time 1 month later, so in February. So what about 2 months later, which would be March? We're expecting, and we always with cohorts, we're relating the customer retention to the number of people who bought for the first time in the cohort. So that's why we're using January 2021 to calculate all of the retention. So we're saying, okay, 12% of the January 2021 clients came back and bought in March 2021. What about in April 2021? Okay, 10%. And you can see with this formula that I locked the column. So no matter if I copy and paste this formula to the left or to the right, it's always going to reference month 0. And I also locked the row. So if I paste this up and down, it's always still going to reference this retention right here. So, I can, that's what I did. I wrote this formula one time and then I pasted it throughout the entire section. So what else are we looking at here? So we have our total clients. So how many clients did we have in January 2021? We know how many clients bought for the first time, and that happens to be the total number of clients because there are no returning clients. But once you get to February 2021, you have your January 2021 clients returning in their basically month 1, and you have your new February clients. So it's not 153, it's 176. And these retention numbers, as you run your business, you'll find out what they actually are, and you can update your models, but they're going to be a really good way to calculate how many customers you can anticipate during a given month. So what about this? March 2021. Well, you're going to have your new clients, but then you're going to have February's returning clients and January's returning clients. So, once you get further down this model, I wrote these formulas. In April 2024, you're not only going to have your new clients from April, but you're going to have your returning clients from every single month before it that you've ever had your company. So in this case, you can see that basically this diagonal line represents April for every single individual cohort. So it's month 39, April 2023, I think this is. 2024 is 39 months later for January 2021 cohort. And so it's really hard to forecast this stuff if you use these sort of fixed models that don't get into the detail. So this cohort will help us anticipate how many clients do we actually expect. And not only that, but each client usually isn't just buying one order. One order. Usually clients buy multiple things at the same time. So we're saying for our model that each client buys 1.3 orders. So our total orders is 1.3 times the total numbers of clients. So now we have the total clients, but we also have total orders for every single month. So for January, for September 2024, we're anticipating, all these clients and 28,000 whatever orders. And so with this, we can easily calculate the revenue. Also, just want to clarify something else. Why did we cut off the cohort at this diagonal line? Well, it's because our model only goes to December 2024. So if we included additional months, it wouldn't actually make sense because these are the people that bought for the first time in December 2024. So this cell would represent January 2025. And we're not forecasting January 2025 in our model. So this cell on every single cohort represents December 2024. So you just take the cohort to the last month of your model because you can't predict forward any further. Okay, so now that you understand cohorts and the math behind them, let's move into the actual P&L itself. So what are we trying to do here? We'll take our cohorts, we'll calculate the revenue, but then we need to think about, okay, what in a marketplace, what's revenue? what's cost? Is the order that the customers make our revenue? Is it our cost? What goes to who? So we're gonna sort through that right now, and it's pretty straightforward. And so we're also gonna make some assumptions around the operating expenses. We're gonna pull in the marketing, we're gonna make up a payroll plan, and we're gonna figure out our burn rate, look at our cash balance, look at our actual runway, which is basically how much money do you have until you run out of money. So it's amount of time that you have. It's like a time bomb. So we'll calculate that. But to start everything off, let's just look at our assumptions. First off, to calculate revenue, we're going to need to look at a couple things here. First off, we need an average order value, which we call an AOV. And you're going to hear people call it AOV, not average order value. So it's a good acronym to get familiar with. So what is our average order value? Let's just say that for this company, it's 75. And what else are we going to need? We're going to need the commissions. So how these platforms make money is they charge, if you're buying a product, they usually upcharge you like a commission, like, oh, you just bought $70 at Airbnb or at Upwork. We're charging you 10% extra as a fee to the platform. So let's say the commission, the upcharge fee is 10% of the order value. So that's to the buyer. And the seller is also going to have to pay a fee. And the reason they pay a fee is because the platform does all the customer acquisition. So the sellers do need to pay some sort of cost. First off, I just want to freeze the panes one more time here. Okay, now it looks better. So we're going to have a commission that also the seller needs to pay. So let's look at this. So let's say the seller pays 20%. So if the seller is paying 20%, why isn't that in our revenue? Well, I'll explain that to you in a moment. It's because the seller is not going to be paying like an upsell, like an incremental amount of revenue. The buyer is going to be paying extra. They're going to say, okay, I'm buying $70 and I'm going to pay 10% more. So I'm really going to pay $77. The seller is going to charge $70, but then we are going to take 20% of that 70 for ourselves. So I'll show you how to calculate that. So let's say here, we charge 20% of the order value to the seller. So the seller is going to keep 80% of the order value. So we'll calculate this in the cost of sales. And then we'll also have credit card fees, which are usually about 2.5% of revenue. Sometimes like a little higher, like 2.9, but this is fine for our model. Okay, so let's look at revenue and costs. So first off, it's always good with your model to pull in things like orders and clients at the very top so people have a reference point, or so you can reference this stuff without having to go to another tab when you're writing formulas. So let's just transpose this straight in here. So total clients, let's just highlight the whole area, click transpose. Again, you can link this in cell by cell if you've got a lot of free time. Total clients, we're going to go to the customer cohort model, highlight, close parentheses, Control Shift Enter. Okay, so you've got the total clients now. And now let's just do the same thing with total orders. So you highlight the entire area, and now you do equal transpose. Again, go back to your cohort model. Orders, Control Shift, down arrow, close parentheses, Shift, Control, Enter. And that's just Shift, Command, Enter on a Mac, but I'm using a PC. Okay, so now we've got this. So this just kind of makes it easier to see if you're going through the model, like, okay, how many orders are we actually generating? Okay, so total net revenue. So our net revenue, we're gonna have basically your seller order revenue. So just like order revenue. Let's just call it the order revenue. So order revenue, and then we're going to have the buyer commission revenue. And those two things together are going to be your total net revenue. Okay, great. So a little formatting, order revenue. So this is going to be your total orders times your average order value. Easy. So let's put a little formatting on that. And then your buyer commission revenue. Okay, it's a 10% upcharge on the order value. So we're going to take our orders and we're going to multiply that by the buyer commission. So you can see that that is 1,121. And those two things together, that's our total net revenue. Easy. So now let's look at our total cost of sales. Okay, so what do we have here? We have our seller order revenue. So that's what we pay back out to the sellers. So we collect 100% of the order revenue here, but then we pay the sellers the 80% that we owe them. We take 20% and then we pay them back out 80%. So this is where that 80% basically goes back out. It's a cost of goods sold expense to us. So in this case, we're going to take order revenue and we're going to put the 80% that goes out of the business to sellers as a cost, because it is a cost to us. And then we have credit card fees, which is just very straightforward. The total net revenue times the fees. And this is just what you have to pay the credit card processing companies, period. Every company has to pay them about 2.5 to 3% for them to process credit card payments. So this is it. And unlike a company that would be doing shipping and logistics and stuff like this, we're just basically matching the buyers and the sellers. So these are our only direct expenses in terms of the product. So this is our total COGS. So we'll put that in bold. We'll add this together. And then you can see that it's $9,278. We can delete this because we just calculated it. And then your gross margin is going to be your revenue minus your COGS. So about $3,000. And with marketplaces, generally, because you're basically reporting in your own revenue that just goes straight back out of the businesses, your revenue is going to be like really, really high. And then your gross margin is going to be really low, like Amazon or like a lot of these huge e-commerce companies that are platforms like Amazon or some of these Chinese companies like JD.com, like their gross margins are like 20% or sometimes less. So this is normal to see. It's how marketplaces work. And you can see that, okay, gross margin is about 25%. Okay, so now let's talk about the operating expenses. So we're gonna have a couple things here in the operating expenses. We're gonna have your team, your personnel expense, and then you're gonna have like other OpEx. This is gonna be your ad spend that we used in the acquisition model, and it's gonna be all of the other things like your enterprise software, like if you have an office rent, all this miscellaneous stuff. And I'll show you a really easy way to just project this whole thing. So let's go down below. And for the headcount, which is going to be your largest expense, usually, or sometimes it's marketing, but it's usually headcount, you are going to just do a couple things here. This is like the super ultra fast startup way of calculating your payroll. So you just put your main sort of cost centers here. So I'm just going to take away this bold. So let's say headcount. Let's say sales/marketing. Then you have creative let's say you have technology, product management, and then you have your exec/admin. So, I mean, your marketing people, your engineers, your product managers, your accounting, your finance, your all this stuff, they all fit into these buckets more or less. And then you have your final bucket, which is benefits, taxes, etc., which is like your additional personnel costs. And this usually is about 25%. So like what you would actually pay to a person, you should increase it by about 25% to account for all of the other benefits. So here, we're just going to put in like the number of each employee. So let's say when we launch this thing, it's got, one marketing person, one engineer, IT person, and one CEO. And that's how you start it. And then let's just kind of build this over time. Let's say you bump it up to 2, and then you get a product manager. Okay, so your team is growing. Okay, so now let's say you go another couple months like this. Now you get to July, and you hire, let's say, another engineer, and then that gets you through the end of the year. And over time, I mean, you'd obviously want to think this out more than I'm doing it, but I'm just trying to put something in here so that our model works. Let's say you start bumping it up. So in January, you really start increasing the team. You have, another marketing person, engineer, product manager. You hire another, I don't know, you hire an accountant or something. And then that gets you through, let's say, December. And remember, this whole time we're growing, and I'm going to put up above like when we're raising money, so you can kind of see that, what's going on from that standpoint. So now let's say this is like 4, 6, 1, 2, 3, and that's your team for year 3. Okay, and then let's say you're getting into year 4, and now it's like 6, 10, 2, 3, 5. So now you're growing the team. So now you have like, let's see what it is, 26 people. So now you're like a startup. Okay, so that's your headcount, right? So we have some assumptions in there. They're pretty reasonable. So how do we calculate this? So let's go up above, insert some rows. And this is kind of a fun trick. It's very lazy, but it actually works. So let's put your team up above. And then we can just put a salary right next to them. And we can just put some basic assumptions in. So, you'd obviously want to like look at your market and, the country you're in, blah, blah, blah. But I'm going to put just some numbers in so the model makes sense. I'm going to say $90,000, $60,000 for creative, $100,000 for engineers, product management maybe $80,000, exec, $125,000, and this is going to allow us to calculate. So we just take this number here, we put a $sign in front of the column and divide it by 12. So that's going to give us the monthly cost in terms of salary of that person. And then we multiply that by the headcount. Very, very simple. So this person is going to cost, or this function is going to cost this amount per month. So we can just multiply these formulas down, and you'll see that this is going to take 60 divided by 12 times one person. Here the benefits are going to be the total payroll times 25%. Again, very simple. So your total personnel expense total personnel expense is here. Let's put a bottom border, which we can do here, or we can do it without the mouse. Just do it like that. Sum, add everything up. And usually on financial statements, when you have like a block of data like this, you leave the $ format, the accounting format, on the top row of data and on the bottom, but in the middle, you take it away and you just put the comma number format. And you always eliminate decimals because it looks messy and it doesn't really help your model. Okay, so this we can calculate forwards. And this you'll see that at the end it'll be calculating the whole team of 20 whatever, and it'll be doing everything accurately. So now we have our payroll forecasted, other OpEx. So what might we have here? First off, obviously we're gonna have our advertising spend. So how can we pull that in? Well, we can just pull that straight in from the acquisition model. Let's see. Okay, 5,000. So 5,000 is your advertising spend. And then let's go down below where we can put some assumptions in. So we have our other OpEx. So let's say we have other marketing. So that's like PR and all kinds of other stuff, marketing consultants and things like this, which aren't like advertising spend specifically, but are related to marketing. Then you have technology. Then you have technology, which, enterprise software and a million other things. Then you have, let's say, miscellaneous fixed expenses. So, and then variable miscellaneous, let's say variable expenses % of rev. Okay, so here's what I'm doing. So you're gonna have some amount of sort of non-changing costs, like if you had an office, and a lot of your things are gonna be non-changing around infrastructure and stuff like that, but a lot of stuff is just gonna grow over time. So we're gonna have a block of like 20 grand a month that we're just gonna put in there. Like, okay, we're just putting that in the budget each month. Let's say 10,000 in enterprise software and 5,000 in, marketing stuff, PR. And this is just gonna be like a % of revenue down here, which we know, we're gonna be spending money over time. And so let's calculate these, multiply them forward, and then pull them into the model up above. So we can just copy and paste these categories in and just pull it in like this. So copy, paste, and then finally multiply revenue by the 5%. Okay. So that is going to give us our other OpEx costs, which we can now add up and multiply forwards. And looks like up above I did not copy and paste the formula forwards, which I will do right now. So if we go back to revenue, yeah, we just need to copy and paste this forward. So Control C, Control V, and what's going on? Oh, it's because these assumptions also need to be copy and pasted. Control C, Control V, and now's the easy part. We just take, let's actually add up the personnel expense. So this is the other OpEx. So we have, let's just say total OpEx. So you can see here is personnel expense plus other OPEX. And then we have the operating profit, which is your gross margin minus your total OPEX. So, we're obviously going to be burning money for a while. And so that's to be expected. But let's say here we can model in, okay, how much money did we start our startup with? So maybe we're like a founding team that has a lot of experience, and some investors put $2 million into the company to get this platform going. So in this case, we'll take the 2 million and we'll add to it the burn rate. And so here's how this is going to work. So we multiply these forward here, and then what you do is you just take each month, you take the previous amount of cash, you put in the operating profit, which is negative, and you can just add here any new capital. So this formula will basically capture the cash balance as we move through time. So let's look at what this actually looks like. Like, does the business become profitable? Do we have enough money? Or, what is what's called the runway? The runway is how much money you have. So let's increase the width of these columns a little so we can see. So this business is burning money, right? And our cash balance is going down, down, down. So let's say in April 22, we're like, okay, we're getting down to 500K. But look at our revenue is now at 200,000 a month. It's grown a ton, and maybe we can raise like a big equity growth round here. So let's say we raise 5 million, and that gives us enough money to keep going. So here, let's just make these columns a little wider. You can see that we are still burning cash, but somewhere around the middle of 2024, our gross margin actually exceeds our operating expenses. So this is when we become break even, and then we actually start becoming profitable. So the 5 million in growth equity got us to this point, and then we can actually generate our own cash from here forward. And this is generally what you want to see, like at the end of 3 or 4 years of your startup, a path to breaking even like this. So this is the kind of model that you could definitely send out to investors and they could dig into. So that's all for today. That is the ultimate marketplace financial model. I hope you learned a ton. By the way, in the description below, you can download this Excel file for free. I've also linked to some of my other startup and finance focused videos as well. And if you found this content valuable, please subscribe and click the alerts notification, like this video, and leave me a comment below. And also check out my online courses if you need to improve your Excel and finance skills. That's all for today, and thanks for watching.